Hello class. Our little review for today is about adjusting entries and how they compare to regular entries to help you reinforce your understanding of these two concepts. So I've made a list here of some characteristics and some examples so we can kind of go over them together. So on your left, as a column with regard to regular entries, on your right, column E is adjusting entries. As we all know, debits have to equal credits for both adjusting and regular entries. So the process of writing a journal entry does not change. There still needs to be a total amount of debits and a total number of credits that equal. That will not be anything different for adjusting entries. However, there are some important differences. Regular entries tend to happen all the time on a continuous basis in most businesses. Regular entries include sales, purchases, collections of cash, payments of cash, all of those things. And those are happening all the time and are usually entered immediately when there is a transaction that's taken place. Adjusting entries, on the other hand, are recorded usually only at the end of the month or other accounting periods. So you kind of wait and then record the change for a whole period rather than every day or even every hour or anything like that. So there's not a continuous amount of adjusting entries, and because if we were, we would go kind of nuts. So we wait till the end of an accounting period to record all of the effect for the month or for the accounting period. With regular entries, they're generally an exchange with an outside party. With adjusting entries, that is not the case. Usually this is an internal only type of scenario in that we need to keep track of what's happened and record it, but if it does not affect outside parties if we do not record it or have it properly recorded. Regular entries, if you forget, will generally be reminded by a source document such as an invoice or a check or even a bank statement will remind you of all the checks you wrote or all the deposits you've made, all of those exchanges. But there will be none for adjusting entries. So often we will have a schedule of adjusting entries at the end of each month, kind of a checklist we'll go through to make sure we have included all adjusting entries. And one of the things we want to be able to do is identify when a particular adjusting entry is needed and when you don't need one. Regular entries often involve cash because your cash payments and cash receipts are all regular entries. Anytime you receive or pay cash, for the most part, that is a regular entry. However, adjusting entries only occasionally use cash. In fact, the only adjusting entries we will see that involve cash have to do with our bank reconciliation. We'll learn later. So for now, none of the adjusting entries we will use involve cash. In fact, the reason why they are needed often is because no cash exchanged hands, and so there is no cash to trace, and that's why there is an adjusting entry that needs to be made. So now some examples as is labeled in red as we come down here a little bit. On the left, again, is a regular entry such as the purchase of an asset. I've given you two examples, prepaid insurance and supplies. It makes no difference from a regular journal entry standpoint whether we pay for it in cash or we buy it on credit and therefore we'll pay for it later. We still have an asset. First one, a prepaid insurance, which means that insurance is going to last for a period of time exceeding 1 month into the future. The second one for supplies, which are going to be used up over a period of time again and provide us for future benefit. On the right is the adjusting entry that might happen at the end of the month or the quarter or the accounting period. Time has passed and we have used up some of that asset. And so rather than count up how much was used like every day or every week, we will wait till the end of the month or the end of the accounting period, and we will calculate how much has been used of that particular asset. So as assets are future benefit, expenses or our current or past benefit, and all of the as time passes, what was the future now becomes the past. And so we see that insurance expense is the debit, record that, and we reduce the same asset that we recorded when we purchased it. So it's a credit to that asset for the amount that has been used, and how much has been used is a matter of calculation. You'll have to check your insurance policy to see what time period it is effective for. Supplies are usually counted up to see how much was used, but the same result happens. We move from an asset to an expense. That makes our net income go down, our assets go down. If we do not make that journal entry, we will still have this whole asset as if it was still available for use, which it is not. And so it would be deceptive to the readers of the financial statement. Okay, and there's some other examples. Let's say we make a loan to someone else, or a bank, or a financial institution. We're going to record a note receivable as a debit, and we're going to credit cash to loan money to others. That involves cash. That is a regular journal entry, an exchange, if you will. We gave them cash in exchange for them promising to pay us. Now, most of the time on this type of a scenario, we will have interest, actually all of the time, and that means we're going to charge this person interest over time. So over here on the adjusting entry, because the time will pass and interest will be earned without actually receiving cash yet, then we will record an interest receivable debit and an interest income revenue credit. And the calculation of how much the dollar amount will depend on how much time has passed since we loaned the money and the interest rate at which we are going to charge our borrower. So this is the regular entry. This is the adjusting entry, and we would make this at the end of the period. Again, this could have been made, say, every day or even every hour if you wanted to be particular about how much interest. The minute you loan the money, it starts earning interest, but we're going to wait till the end of the accounting period and record that like this. And then when we collect the money from our customer, we're going to debit cash and credit the receivable. That will be another regular entry because it involved cash and exchange. This is the adjusting entry. Another way to receive cash is if we were, or in this case, we're receiving cash. We were paying cash. We receive cash in return for a promise to provide services in the future. So we haven't done anything for this cash, so it is unearned revenue, a liability. So assets go up, liabilities go up. After time passes and we have actually done something, whatever it was that we originally received the cash for to do, at least partially done, then we will debit unearned revenue and credit revenue because now it is earned. So receiving the cash is a regular entry. Recording that we've earned part of that is an adjusting entry. And again, we could do it every time we earn something, every hour we spent on this project, every item we did, but most of the time, many companies will wait till the end of the accounting period and record all that was earned for that particular month or accounting period. And that's kind of how we've illustrated this. Last example, if we borrow money from the bank, borrow cash, we're going to debit cash just like we did before and credit loan payable, which of course is a little different than unearned revenue because unearned revenue we expect to actually earn. Loan payable, we're going to pay them back at some point. And in the meantime, it's going to accrue interest. And accrued is just owed over time. So over here in the adjusting entry at the end of the accounting period, we know that time has passed, some time passes, and interest is accrued or owed. To record that, we debit interest expense and credit interest payable. If we don't complete these adjusting entries, even though there's nothing to remind us, our financial statements will be incorrect. For instance, if we fail to record this accrual here, this accrued expense, then interest expense would be too low and our net income would be too high. We'd have too few expenses. And our interest payable would be too low, meaning we wouldn't have a liability for this interest we owe on the balance sheet, which would mean our liabilities are too low. And that would also be deceptive to our arrears of financial statements. So the whole point of accrual of adjusting entries is to follow the matching principle and record expenses and revenues in the time period, the accounting period in which they are actually earned or used, not just when the exchange happens. So whenever the amount used or earned is a different time period than the actual exchange, you need to record an adjusting entry, and remember to do so. So here's the exchange. Time period where it was used is a different time period than when it was exchanged, so forth. On each one of these, that's what they have all in common, and that's what adjusting entries allow us to do, is do what we call accrual accounting, or the matching principle, which matches revenues and expenses.